Thank you for joining. We're going to get started in just a minute. Good afternoon, everyone. I'm Olivia, and I'd like to thank you for attending today's webcast. Today we'll be presenting Financial Services Tax Update, which will be led by Tim, Alex, Harold, and Eileen. Before we begin, I'd like to review a few housekeeping items. First, we encourage you to ask questions. To do so, please send them to us using the Q&A box on the lower left-hand side of your screen. We will try to answer all of your questions during the webcast, but if a fuller answer is needed or if we run out of time, your question will be answered later via email. Second, to earn the available 1 CPE credit during today's webcast, you must listen to at least 50 minutes of the presentation and answer at least 3 polling questions. Please note that you must be logged in individually to receive credit for today's webcast. If you are attending as a group, only the individual who is logged in will receive credit. If you've completed the requirements, your certificate will be available for download at the end of the webcast. I'll walk through how to download your certificate after the presentation has concluded, so please stay on the line. Lastly, you can download a copy of today's presentation from the green Resource List button at the bottom of your screen. Here you will also find our webcast Frequently Asked Questions, a document which offers some basic troubleshooting information and other useful tips. Again, this can be found under the green Resource List button at the bottom of your screen. Now, thank you once again for joining. I'll hand it over to Tim.
Thanks, Olivia, and welcome to the Financial Services Tax Update. I'm Tim Evans. I'm a partner in the International Tax Practice. So today we're going to go through a brief international update, some state and local update, cryptocurrency update, and also discuss briefly the recent Inflation Reduction Act. So the first topic are the final regulations on Libel transition. So just by way of background, in 2017, the UK Financial Conduct Authority announced that the London Interbank Offered Rate, or Libel, would be phased out. And so as a result, financial institutions and other parties would need to identify and utilize alternative reference rates. So obviously, there are a few tax issues that arise as a result of this, but really primarily the concern comes down to whether the changing of a reference rate constitutes a significant modification of a debt instrument for purposes of 1001, which would result in a sale or exchange. So generally, the final regs adopt the proposed regulations with a few small modifications. A couple of those highlights include so covered modification. So if you have a covered modification, it's not going to be treated as an exchange. And there are several elements to that. So you've got an operative rate or a fallback rate that references a rate that will be discontinued or has been discontinued. You have a modification to replace that discontinued rate with a qualified rate, and the modification is not an excluded modification. Discontinued IBORs, discontinued rates, a rate that's going to be discontinued, and it ceases to be a discontinued rate 1 year after the discontinuation. So In other words, the time to apply these regulations is limited. It's not open-ended to make these changes forever and not be considered a sale or exchange. A qualified rate, that's going to be on the list of eligible rates, for example, like the secured overnight financing rate. Basically, the interest rate has to refer and be based on transactions that are conducted in the same currency, or at least otherwise reasonably be expected to measure variations in the cost of newly borrowed funds in the same currency. And one thing that the final regulations did was remove a fair market value requirement, where the fair market value of the modified contract had to be substantially equivalent before and after the modification. And so based on comments that implementation of that would be impractical, that rule was replaced with a list of modifications that are excluded from the definition of a covered modification. There's also a grace period that was put in the final regulations, 90-day grace period for integrated transactions and hedging transactions, where you might have a mismatch, where one component was modified and another was not yet, and so that grace period prevents the mismatch from being treated as lagging out. So these final regulations are going to apply to modifications to contracts where the modification takes place on or after March 7th of this year. Next topic, OECD Pillar 1 and also Pillar 2. So these are culmination of the OECD's work combating the effects of the digitalization of the economy. And so sort of central to these efforts is really the idea that in the modern economy, actual physical presence is less and less a factor in how and where multinationals derive their revenues. So Pillar 1, which is very limited in scope, it's only going to apply to multinationals that have 20 billion in revenue and a profitability of at least 10%. But Pillar 1 introduces a new taxing right for so-called market jurisdictions, which are basically jurisdictions where you have consumers and users, but there's no physical presence of the multinational. So in connection with this right, a share of the multinational's profit would be reallocated to those market jurisdictions. And so even though the initial threshold will be 20 billion, it is anticipated that, after an implementation period, I think currently 2030 has been proposed, that threshold would come down to 10 billion, so increasing the scope fairly significantly. Certainly, for this audience, of great importance is the fact that regulated financial institutions are excluded from the scope of Pillar 1, but that is an exclusion from Amount A, which is essentially that new taxing right. There will be potential relevance for the Amount B, which is basically a baseline for marketing and distribution activities that are performed in market jurisdictions, so that may impact transfer pricing methodologies. And Pillar 2, this is much broader in scope. So Pillar 2 is going to apply a global minimum tax of 15% on multinational enterprises with revenues of at least 750 million euro. So essentially, the framework requires in-scope multinationals to determine effective tax rate on a constituent entity by entity basis. And then if the group has any entities that are subject to effective tax at less than 15%, you calculate a top-up tax, which is then imposed on the parent entity. There's also, as part of the regime or framework, the concept of a qualified minimum tax, domestic tax. So various jurisdictions around the world may be implementing local legislation to essentially capture that top-up tax in their own jurisdiction. So it would be imposed in the foreign jurisdiction in this case, rather than being a top-up on, for example, a U.S. parent. From a U.S. perspective, currently the U.S. legislation doesn't really allow or permit the implementation of Pillar 2. So guilty is one of the things that needed to be changed in order to implement Pillar 2, both needing to be computed on a jurisdiction-by-jurisdiction basis, so you wouldn't be able to offset tested income and loss of various entities. But also the rate imposed under guilty would have needed to change. And so we just had the Inflation Reduction Act, which introduced a 15% minimum tax, but for various reasons that falls short of what would be necessary to implement Pillar 2 in terms of actually computing the amount and applying various credits and also applying it on a sort of jurisdiction-by-jurisdiction basis. So as it stands, it looks like U.S. groups will potentially be subject to top-up taxes, potentially in other jurisdictions if they impose qualified minimum domestic taxes, because the effective tax rate that they'll be paying on that foreign income in the U.S. is ostensibly going to be lower than the required 15%. So currently, it looks like Pillar 2 will have some significant impacts on U.S. companies that operate in multiple jurisdictions, but I think there is a desire, at least in Treasury, to try to work something out to bring our local laws more in line with Pillar 2 implementation. And the final topic on the international side relates to changes to the QI agreement, really to implement 1446A and F with respect to interests in publicly traded partnerships. So only publicly traded partnerships, not non-publicly or non-publicly traded partnerships. So basically, under Section 1446A, you've got a withholding tax that applies on a partnership's effectively connected income that's applicable to a partnership's foreign partners. And these changes allow for a QI to assume primary withholding responsibility on distributions from a publicly traded partnership. On the 1446F front, that's a withholding regime that applies when you have a buyer of an interest in a partnership from a non-U.S. seller. And that's a requirement to withhold 10% of the gross amount paid. And so if the publicly traded partnership is held with a broker, that withholding obligation shifts to the broker. And where that broker is a QI, these changes will cover what the QI's responsibilities are with respect to that sale. So the changes cover your standard information reporting aspects, so withholding, documentation requirements, reporting. And so really, I think QI banks, what they should be doing now is reviewing whether they've got clients that currently invest in publicly traded partnerships, particularly ones that generate effectively connected income. And to the extent they do, or the bank permits those sorts of investments, really making sure that it has the capability to identify payments relating to the sale of publicly traded partnership interests. And then also, I think, take some time to consider whether you would want to be adopting primary or secondary withholding responsibility. That's sort of a decision tree that will impact what your specific withholding and documentation and reporting requirements are going to be with respect to those transactions. So something to be thinking about. The modifications will be in effect for the new QI agreement that comes into effect January 1, 2023. That brings us to our first polling question, which is, what is the expected impact of the Pillar 2 rules on your company? And I'll give you a minute or two to respond to that. Still waiting for quite a few responses. I'll give you another few seconds here. Okay, so the results, looks like most people are expecting minimal or no impact. A few of you out there expecting a significant impact. Yeah, I definitely think that the way Inflation Reduction Act came out, you know, without some of the changes that people were hoping to see, will lead to a larger impact on U.S. companies. But I think it's definitely something that bears watching, and I would expect additional developments over the next remainder of this year and next year, certainly. So with that, I will pass things along to Harold for the state and local update.
Thank you, Tim. I'm Harold Hecht, Managing Director and the leader of the state and local tax practice for Mazars in the U.S. In today's presentation, we'll be focusing on new developments for New York State and New York City, including 2 recent court decisions, updates to New York State's pass-through entity tax, the enactment of a New York City pass-through entity tax, and finally the current status with respect to the long-awaited proposed regulations from New York State with respect to the 2015 tax reform. So let's start with a discussion of the case that was handed down April 12th of this year in a matter of Goldman Sachs Petershill Fund Offshore Holdings. Here the courts upheld prior decisions by the New York City ALJ and New York City Tax Tribunal, which held that effectively Goldman Sachs Petershill, which was a non-New York City corporation that held a partnership interest in a partnership doing business in New York City, was required to report the gain on the sale of its partnership interest to New York City. This is really a very intriguing issue overall in state and local taxation when either a corporation or a partnership sells a partnership interest in trying to determine which state or states that income should be either apportioned or allocated to. So here, the City Tax Tribunal had ruled that the capital gain was attributable to the capital appreciation of the partnership city business and therefore had nexus to the city, that effectively the Goldman Sachs entity was doing business in New York City by virtue of its partnership interest. And finally, what was pointed to was the fact that here we had a claim for refund that was issued. So on its original returns, the Goldman Sachs entity had reported the gain and paid tax in New York City on the gain and then filed claims for refund. So what was cited was the fact that, in effect, that Goldman Sachs entity, by reporting its share of Clarence income on its general corporation tax return, admitted it had nexus to the city as a result of the ownership of the interest. So just, I guess, a word to the wise when filing an original return. You always have a potential issue here where it could be cited in a claim for refund proceeding that perhaps what you filed originally could be held against you. Next case is the BTG Pactual case, also known as when is a disregarded entity not entirely disregarded for New York State, and for that matter, it's also New York City purposes. By way of background, BTG Pactual Corp. Owned a single-member LLC. BTG Pactual Corp. Was not a broker-dealer. However, it had a single-member LLC that was a broker-dealer. Again, another case where a refund claim was filed, in this case for 2012 and 2013, and these were years prior to the 2015 tax reform, where there was customer-based apportionment only for specific industries, which included in those years broker-dealers. So broker-dealers were allowed to apportion income based on where the customer is located rather than where services were rendered. So here BTG took the position that because the single member LLC had the broker-dealer license and was a disregarded entity, that attribute could pass up to the single member, and that the single member could also use the customer-based apportionment with respect to non-broker-dealer services. And in fact, that was pretty consistent with New York State's guidance that had been issued in that time frame. However, in 2017, the state reversed course. They issued guidance that indicated that where a single member owned a single member LLC that was a broker-dealer, that the single member LLC was the only entity that could use the customer-based apportionment, and that effectively that attribute did not pass up to the single member, in this case a corporation. Unfortunately, the court found no basis in BTG's argument that the check-the-box regs allowed the single member receipts to be sourced as if it was a broker-dealer. And effectively they said that it was unambiguous that customer-based sourcing was meant to apply only, was not meant to apply to the financial services industry as a whole, only the broker-dealers. So this is a case, I think, that was somewhat surprising on many fronts, but it is what it is. It does have also applicability going forward to the New York City UBT and for the city general corporation tax on S corporations, both of which have not adopted customer-based sourcing. We'll move now to our second polling question, which is, what is the status of New York State's proposed regs on the tax reform? Are they still under consideration? They've been adopted, they've been withdrawn, or none of the above? I'll give you a minute or so to enter your response, and don't forget, in order to receive CPE, you need to respond to the polling questions.
I do see that we have a question that says that you couldn't answer the first polling question. You only need to answer 3 for CPE credit, so don't worry if you weren't able to do the first one. Just make sure you answer the last 3.
We'll give you another 30 seconds or so to enter your response. Looks like at this point, only a little more than about 60% of you have responded. we'll give you another 15 seconds or so, and we will move on. Okay, we're going to close the polling, and it looks like more than half of you are correct that the proposed regs are still under consideration. And in the final slide, we'll briefly speak about that as well. Next item is the New York State pass-through entity tax. As many of you may recall, the TCJA imposed a $10,000 limitation on state and local tax deductions, and in response to that, many states have enacted pass-through entity taxes as a workaround that shifts the tax liability from the individual for pass-through entities to the pass-through entity, with a corresponding credit then being allowed to the individual shareholder or partner. New York State enacted their PTET in 2021, and now in 2022, a couple of corrective measures have taken place to address perhaps what might have been shortcomings or items that certain taxpayers were not happy about. So specifically for S corporations, there's a new electing resident S corp category. So the tax years beginning on or after January 1 of 2022, an electing resident S corp can include in its PTET all items of income, loss, gain, or deduction to the extent it's included in the taxable income of the resident shareholders. So this addresses what was a discrepancy between partnerships and S corporations in the 2021 year, where for S corporations, the PTET was calculated based upon the business allocation percentage of the S corporation, regardless of the resident status of the shareholders, whereas partnerships were allowed to calculate their PTET based on 100% of the distributive share of a resident partner. So an electing resident S corp certifies at the time of its election that all the shareholders are residents of New York. So if you have even one shareholder that is not a resident of New York, unfortunately, you cannot elect the resident S corp status. And unfortunately, if that certification is not made, then the S corp will continue to be treated as an electing standard S corp. So if you have an S corp that's got all New York shareholders, make that resident S election. Also, the state has extended the due date only for this year for the 2022 PTET elections to September 15th. So it was originally March 15th. It's now September 15th, with the caveat that any late election also requires the payment of estimated tax equal to if the election is made between March 15th and June 15th, you have to have a 25% estimated payment made with the election for it to be valid. And again, if it's between June 15th and September 15th, a 50% payment has to be made in order to have a valid election. New York City has joined the bandwagon, effective for tax years beginning on or after January 1, 2023, although there is some talk that the legislature might accelerate that to January 1 of 2022. The city is offering a PTET imposed at the city highest marginal tax rate, and this PTET will be in addition to the city UBT and the general corporation tax imposed on pass-through entities. With respect to the election, it can be made by an eligible city partnership or an eligible city resident S Corp. The eligible city partnership is defined as a partnership that has a New York partnership return filing obligation and at least one partner or member is a city resident, whereas the eligible city resident S Corp must have only city resident individuals. So an S Corp with any non-residents of New York City cannot elect into the city PTET regime. And similar to the state, the city PTET will pass through a dollar-for-dollar credit to the shareholders, partners, or members. And I guess one caveat is if you're going to make either the state or city election, if you haven't already done so, please don't wait until September 15th to do it, as last year the state had a lot of issues with respect to their system getting jammed up at the last minute. And finally, with respect to the tax reform regs, the state is seeking final comments on the regs. It's only taken them, I guess, 7 years to try to get to the point of actually adopting the regs for the 2015 tax reform. And hopefully, by the end of the year, we'll see the final regs adopted. And with that, that concludes the state and local update. I'll now pass it on to Alex.
Thanks, Harold. Hi, everyone. I'm Alex Durienzo. I'm a senior manager in our financial services tax group here at Mazars. I'm based out of our New York office. Today, we're going to be going through a brief cryptocurrency overview of, the tax implications and some updates on proposed regulations that have been working their way through Congress. But first, let's start with a polling question, kind of gauge everyone's kind of involvement in cryptocurrency. I'll give you about 30 seconds to answer this. And if you haven't answered already, let's try and get an answer in just so you get your CPE credit. All right, so looking at this, it looks like some of you have investments in crypto, and some of you may not have too much activity, but I guess, all of us can, learn a little bit more today and potentially change that if wanted. So to start out, with cryptocurrency's rise in popularity over the past few years, so has the attention it's received from the IRS. Cryptocurrencies such as Bitcoin and Ethereum have emerged as popular investments, but not all investors are aware of the related tax implications when buying and selling crypto, or when using it in lieu of cash to purchase goods or services. Tax guidance on cryptocurrency and other digital assets have been fairly limited since its inception. So in 2014, the IRS issued its first round of guidance on their view of crypto in the form of Notice 2014-21. And with that, they added an FAQ section to their website to answer some common questions about cryptocurrency and how it's taxed. In 2019, the IRS followed up with Revenue Ruling 2019-24, providing some additional guidance on forks and airdrops, and they updated the FAQs to include some of this information as well. So with this guidance, the IRS basically defined cryptocurrency as quote-unquote virtual currency, and indicated that crypto would be treated as property for federal income tax purposes. So what this clarified was despite its name, cryptocurrency would not be treated the same way that fiat currency, such as U.S. dollars or other government-backed currencies would be treated, since property is not considered the same as cash. The IRS also provided guidance on common taxable and non-taxable transactions, which is much of what the FAQs provide for. We'll get into that a little in a second. Also in 2019, the IRS introduced a question on individual taxpayers' returns as to whether they hold cryptocurrency or have any transactions involving cryptocurrency. This question has been adjusted on the draft 2022 individual tax returns that came out fairly recently to be a little more specific as to what types of transactions the IRS wants to know about. And the change in this question is likely due to some confusion on whether merely purchasing cryptocurrency required an answer. So the IRS isn't really looking for this, but rather, they're looking for what you do next with that cryptocurrency that may have a tax impact. But either way, the inclusion of this question is a clear indication that the IRS is focusing its attention on cryptocurrency, and it's an area that the service has expressed they feel is being greatly undertaxed. Just to point out, the point on this slide is a bit misleading, as the applicability of the question on the individual tax return is more or less the same than it was in 2019, but now it just has a little more clarity with the changes. So what type of cryptocurrency transactions are taxable and how are they taxed? Since cryptocurrency is treated as property for tax purposes, it can be viewed as a capital asset in the hands of an investor and can be treated similarly to other capital assets such as stock. So for more basic transactions, this would mean that the purchase of cryptocurrency with US dollars or other fiat currency is not a taxable event, and the sale of cryptocurrency for cash is taxable. However, the purchase of cryptocurrency with another type of cryptocurrency is a taxable event because it's considered an exchange of property, which is generally taxable for U.S. income tax purposes. Tax on this type of transaction will be calculated based off of the gain or loss from the appreciation or the depreciation on the assets or cryptocurrency being exchanged. Another transaction that becomes a little more complicated when using cryptocurrency is when goods or services are purchased using crypto because it's taxable to both the buyer and the seller. The seller in this type of transaction has a gain on the fair market value of cryptocurrency received less any cost of goods sold, but the buyer also has a potential gain or loss on the change in value of the cryptocurrency being used as consideration. So it's not something that you would typically see when cash is being used in the same circumstances, which is why a lot of people overlook the situation. As far as the tax rates that apply to cryptocurrency, crypto generally receives capital gain treatments in the hands of an investor, and it's also generally subject to the net investment income tax. So you're looking at a 20% capital gains tax rate plus 3.8% net investment income tax from gains on crypto sales. That's also assuming that you've held crypto for over 1 year to qualify for long-term capital gains treatment, or else short-term gains might get taxed at a higher rate. In the fund world, GPs and fund managers have to take into consideration that Section 1061 also applies to cryptocurrency in the event that long-term capital gains that are realized are allocated to a GP as part of a profits interest or carried interest arrangement. If this is the case, then the holding period for cryptocurrency needs to be examined to see if any long-term capital gain ends up being treated as short-term gain in the hands of a carried interest holder. And this is due to Section 1061, which was introduced in 2017 with the Tax Cuts and Jobs Act, when you're extending your holding period from 1 year to 3 years for carried interest capital gains, that's essentially what's needed to be eligible for favorable long-term rates. So for some areas where cryptocurrency differ from what we're normally used to with capital assets, an area where regulations haven't quite caught up yet for cryptocurrency is wash sales and constructive sales. As of right now, these provisions don't apply to cryptocurrency, which actually opens up significant tax planning opportunities, especially when the crypto market is trending downwards like it is now. But these are loopholes that Congress has been keen on addressing in the near future, so if we are planning to take advantage of these opportunities, it's something that needs to be done now because they are looking to close these sooner rather than later. It's also worth noting that Section 1256 applies to cryptocurrency, but in a limited capacity. Right now, only Bitcoin qualifies for mark-to-market 1256 treatment, but the Commodities Futures Trading Commission, the CFTC, they've indicated that Ethereum and other cryptocurrencies will likely qualify as commodities in the near future and become eligible. So now I'd like to turn our attention to some proposed regulations that are currently making their way through Congress and that would impact the cryptocurrency industry. Previously, that's all kind of what's been addressed so far and what we know in terms of how cryptocurrency is taxed. But in early June, Senators Loomis and Gillibrand introduced the Responsible Financial Innovation Act, or the RFIA, which includes some pretty significant changes to cryptocurrency regulations and tax measures. Looking at some of the highlights from the tax measures first, the one that's gotten the most attention is the de minimis exemption. And the de minimis exemption would effectively allow for no tax gain or loss to be recognized for certain transactions up to $200. The intent for this exemption is to alleviate the administrative burden that would come with using cryptocurrency for everyday goods and services. So, for example, if for some reason I decided to buy a cup of coffee every day and use cryptocurrency to pay for it, I would actually have to calculate a tax gain or loss every day that this occurs. This would obviously create a huge compliance burden come tax filing time, which is why it would really not be wise to do this unless for some reason you really enjoy using your crypto for that type of activity. But the exemption would alleviate the need for individuals to keep track of these types of purchases and actually allow them to use cryptocurrency almost like a form of currency in the same way that, if we're going to Starbucks and paying with cash, we're not doing tax calculations when that occurs. Another major proposed item is from this bill is clarifying when tax is due for staking and mining activities. So no guidance on these activities currently exists, but the conservative approach would be to recognize the income from these activities when property is received in a staking or mining transaction. The bill proposes that gain would actually be deferred until staking or mining property is subsequently sold or exchanged, and this rationale is consistent with the treatment of creating other types of properties. So, for example, you wouldn't tax an artist for painting a picture or, tax a contractor for building a house. They would be taxed when they, sell this type of property. This topic is also at the center of an ongoing court case, Jarrett v. the United States, where all indications so far point to the IRS conceding this position that's being proposed in the bill, and they've actually already refunded the plaintiff's tax dollars in this case. The only reason it's still going on is because the plaintiff is pushing for a ruling regardless. So definitely something that's being seen as taxpayer friendly if potentially added by the RFIA. Some other tax measures highlighted include cryptocurrency lending agreements, which would generally not be taxable, which is similar to securities lending agreements. And along with several other directives, one requires Treasury to issue further guidance on transactions such as forks and airdrops, which are currently included in the IRS FAQs I mentioned earlier, but lack regulations to support it. So with that, turn to a few proposed regulatory updates that are worth mentioning in addition to the tax measures. Some of these are due to obvious regulatory needs that are missing from the digital asset industry, and others are seen as a reaction from ongoing industry requests. The first of which would make the CFTC the primary regulator of digital assets and cryptocurrencies, although with some exceptions. Currently, there's a lot of overlap among the CFTC and the SEC regulatory bodies, which has led to a lot of confusion on who has jurisdiction in certain cases and which standards those in industry must abide by. The SEC would still have jurisdiction in cases where digital assets are classified as securities, but the CFTC should have jurisdiction in most other cases, including where cryptocurrency is classified as commodity or a quote-unquote ancillary asset, which is a newly defined term by the RFIA. Another item is the term digital asset broker, which has been a topic of contention as of late. So back in November 2021, when Biden pushed through the infrastructure bill, this definition was provided, and it was seen by industry as being overly encompassing to include a lot of people who wouldn't normally be expected to have the responsibility as a broker. So after a lot of pushback from industry, the RFIA now proposes to pull back and kind of narrow the definition of who would be considered a digital asset broker, and this would be more akin to the role of a securities broker. So it gets a lot of people out of reporting requirements that I realistically would not be able to handle. The bill also targets stablecoins, for which regulation has been of heightened importance since the crash of the popular stablecoin Terra USD that had originally been marketed as worth equal to $1, but in reality the token hadn't been fully collateralized with fiat currency, which is one of the reasons it crashed, and crashed as hard as it did. The bill proposes that stablecoin issuers would now be required to disclose the assets that are backing their tokens and require them to maintain full reserves against them. So these types of disclosures and assurances provide much needed transparency and security for investors that are interested in stablecoins, and gives them an opportunity to have a better understanding of what they're investing in the first place. Last thing I want to note is the bill creates a default tax classification of a business entity for decentralized autonomous organizations, or DAOs. Currently, DAOs can operate without formally registering with a state or adopting a legal entity status such as an LLC or a corporation. And including this provision in the bill is likely a reaction to this practice, which now dictates that a DAO can't be treated as a disregarded entity for tax purposes. So the bill has several other provisions that we won't have enough time to cover all of them today, but it'll be interesting to see over the next couple of months, especially after midterms, to see which ones actually make it through Congress and if any actually get enacted into law. So with that, I will turn it over to Eileen, who will discuss the Inflation Reduction Act.
Thank you, Alex. Good afternoon, everyone. I'm Eileen Mack. I am a partner in our Financial Services Tax Group here in New York, and I'm going to be discussing the Inflation Reduction Act. On August 16th of 2022, President Biden signed the Inflation Reduction Act of 2022. This is a significant reduction of his more ambitious Build Back Better that did not get passed. So I will be providing an overview of some of the salient points impacting corporate taxpayers. Really, the most significant item is the book minimum tax. So this is a 15% tax that's imposed on certain large corporations. It's very similar to the old corporate alternative minimum tax. And this tax applies if the corporation is an applicable corporation, i.e. it has an average annual adjusted financial statement income in excess of $1 billion over a 3-year period. So what you will look at would be an average for 2020, 2021, and 2022. There are special rules if a corporation has a foreign parent. The multinational group must have an average adjusted financial statement income in excess of $1 billion, same as the domestic corporations. And the U.S. members of the group, U.S. trade or business of foreign group members, and foreign subsidiaries of U.S. members, adjusted financial statement income must exceed $100 million. So what we do is we look at the definition of what is the adjusted financial statement income. It's defined as income prepared in accordance with U.S. GAAP or IFRS. And there are certain adjustments as well, including financial statement NOLs, defined benefit pension plans, Section 168 tax depreciation, and that includes bonus depreciation, certain amortization, foreign tax credits, and general business credits. There are questions as to what is the starting point in determining the adjusted financial statement income of a U.S. branch of a foreign corporation. An argument can be made that you would apply the effectively connected income principles of Section 882. And you would have adjustments for interbranch transactions, interest expense under 1.882-5, head office expense, and non-effectively connected income. A question arises if a foreign corporation uses the authorized OECD approach and applies the treaty method. We'll have to wait for some guidance from Treasury as to how they would be calculating their adjusted financial statement income. In terms of the book minimum tax, there are also aggregation rules, and the adjusted financial statement income includes all members of the control group. And this alternative minimum tax, it applies if the regular tax and the BEAT is less than this alternative minimum tax. And similar to the AMT that we had in the past, there is also a minimum tax credit, and it has an indefinite carry forward. It's important to note that the book minimum tax is effective for years beginning after December 31st, 2022. The next item that I will be discussing will be the 1% excise tax on stock buybacks. This was designed to discourage stock buybacks or to make them more expensive. And it applies to covered corporations, i.e. domestic corporations whose stock is traded on an established securities market. And there are certain exceptions also to the stock repurchase provision, such as Section 368A reorgs, stock contributed to certain qualified retirement plans, annual stock buyback of $1 million or less, repurchase by a dealer in securities in the ordinary course of business, repurchases by RICs or REITs, and repurchases treated as dividends. This excise tax is calculated based on the fair market value of the repurchased stock, less the fair market value of any stock issued. There are also special rules for affiliates and applicable foreign corporations. It's important to note that this 1% excise tax is not deductible for federal income tax purposes. And we'll also need to get significant regulatory guidance from Treasury regarding redemption of preferred shares, split-offs, and other types of corporate restructurings. The Inflation Reduction Act also has numerous clean energy tax credits and conservation incentives. Too many for me to go into detail today. But if anyone is interested in learning more about them, Ryan Vaughn, who heads up our credit and incentives group, can definitely assist you in that area. So let's go to our last polling question. So this is a pretty easy one. Which president signed the Inflation Reduction Act? So I'll give everybody a minute to respond. I think about half the people have responded so far, so I'll give you guys some more time. Okay. So you guys did really well, 94.4%. So thank you for that. And as Olivia mentioned earlier, if anyone has any questions, please include it in the chat box and we will get back to you. And on behalf of Tim, Harold, Alex, and myself, as well as our financial services tax group and our firm, I want to thank you so much for joining today's webcast. And I'll turn it over to Olivia to close this out with some housekeeping items.
Perfect. Thank you so much. Okay, let me make sure I got this on the screen for you guys. We hope you enjoyed today's webcast. As Eileen said, thank you all for attending. If you've completed the CPE requirements, your certificate is now available for download. I will put the instructions on the screen shortly. We encourage you to tell us what you thought by completing the webcast feedback form, which you will be redirected to shortly and will also appear as a link here. Please take a minute and fill out once we conclude. Please feel free to reach out to me or to any of today's presenters with any questions. Thank you once again for joining and enjoy your day.